They reflect most of the energy. Nuburu's blue light, however, is absorbed at a much higher rate. This means cleaner, stronger, faster welds. The narrative, therefore, is simple. As the EV industry, led by giants like Tesla stock, scales up battery production, Nuburu's technology should become the industry standard. It seems like an inevitable conclusion. Investors, perhaps those self-investing on SoFi Invest or discussing ideas on forums, see this technological edge and assume market success will follow. But the reality, what the market is screaming at us with this 0.215 stock price, is that a brilliant piece of technology can be attached to a failing business. The market is signaling that Nuburu has a critical, perhaps fatal flaw that has nothing to do with its lasers. The problem is the balance sheet. This company is burning cash at an alarming rate, and the timeline for widespread commercial adoption is proving far longer and more expensive than anyone anticipated. While the expectation is focused on the science, the reality is that this company is in a desperate race against time. This is the kind of hyper-speculative, high-stakes situation that sophisticated day traders, maybe using the Interactive Brokers trading platform, might try to scalp for pennies. But it is an absolute minefield for anyone just looking for long-term investment or a stable addition to their portfolio. This isn't Apple stock. It doesn't have a fortress balance sheet. This isn't Nvidia stock, which dominates its market and prints cash. Nuburu is, at this moment, a consumer of cash, and its ability to raise more is in serious doubt. Let's dissect the recent movement that brought us to this point, because that 0.215 close on Friday wasn't an isolated event. This stock has been in a catastrophic downtrend for the better part of a year. It has blown through every conceivable support level. What we are witnessing is the anatomy of a complete collapse in investor confidence. This isn't the orderly, low-volume drift of a mature company. This is a panic. The high volume we saw Friday is particularly concerning. When you see a massive volume spike on a sharp down day, after an already prolonged decline, it often signals one of two things. The first is final capitulation. The very last bulls, the ones who held on believing in the blue laser story, finally gave up and liquidated their positions. The second, and perhaps more likely scenario, is forced selling or significant dilution hitting the market. This could be warrants being exercised and immediately sold, or a lender calling a note. For anyone investing online, this is a classic trap. They see a stock that was once $2, now at 21 cents, and think, how much lower can it go? The answer, unfortunately, is always zero. We also have to place this in the broader macroeconomic context. We are in an environment where capital is expensive. The market is ruthless. It has no patience for companies that are pre-profitability and have an insatiable cash burn rate. The focus has shifted entirely from growth at any cost to a clear path to profitability. A company like Nuburu is the poster child for the kind of stock that institutions are abandoning in a risk-off environment. This is where portfolio management, perhaps through a diversified account at Fidelity Investments or using a robo-advisor like Schwab Intelligent Portfolios, is so crucial. You must insulate your core holdings, your Fidelity mutual funds or Fidelity ETFs, from this kind of extreme risk. This isn't an investment, it's a speculation on survival. The recent Q3 earnings report was the nail in the coffin for many. The market was desperately hoping to see a significant ramp-up in revenue, some sign that the sales pipeline was converting. Instead, revenue was flat, and operating losses actually widened as the company continues to spend on R&D and sales efforts that aren't bearing fruit. Management's commentary was, as expected, focused on the pipeline and future potential, but the market has heard that story every quarter while the losses mount. The reaction was immediate and brutal. If we look at institutional ownership, the 13F filings from the last quarter are telling. We are not seeing major funds initiating new positions. We are seeing the opposite. Funds that got in early, perhaps through the initial SPAC merger, are quietly heading for the exits. The smart money is not buying this dip. They are waiting. They know that a company in this position, with a stock price this low, is backed into a corner. The New York Stock Exchange American has listing requirements. Nuburu is in breach, or very close to being in breach, of the minimum bid price rule. This means a reverse stock split is almost certainly on the table. A reverse stock split does nothing to fix the underlying business. It's a cosmetic change to prop the price back up, and in 99% of cases, it's a precursor to even more selling and more dilution. It's a signal that the company is more focused on its listing status than on its actual operations. This is where the contrast with other investing sites and platforms becomes so clear. Checking your Fidelity brokerage account to look at a utility stock is a calm experience. Checking Nuburu on the Robinhood stock trading platform is an exercise in anxiety. The user experience on the Fidelity mobile app is built for long-term wealth management. The flashing red and green of a stock like this feels out of place. This is a specialist's game. This is the kind of security that platforms like Interactive Brokers are built for, offering complex order types for traders who understand the extreme risk. Platforms like SoFi, which are trying to build a comprehensive financial picture for their clients with SoFi Investing, would likely categorize this stock in their highest risk tier, if they cover it at all. The competition is also a factor that the bull narrative conveniently ignores. While Nuburu's tech is unique, they aren't the only ones working on solutions for welding copper. Established industrial laser companies have massive R&D budgets and, more importantly, existing relationships with all the major auto and electronics manufacturers. Nuburu isn't just selling a laser, it's trying to displace deeply entrenched multi-billion-dollar suppliers. That is a monumental task for a tiny company with dwindling cash. So what exactly is this business? Let's briefly cover the fundamentals. Nuburu Incorporated designs and manufactures high-powered blue lasers. As I mentioned, their core value proposition is that their specific wavelength of blue light is ideal for materials processing of reflective metals. Traditional infrared lasers, when hitting copper, are about 95% reflected. Nuburu's blue light is up to 80% absorbed. This fundamental physics advantage is supposed to unlock new capabilities in EV battery manufacturing, welding the foil stacks and bus bars, 3D printing of copper parts, and consumer electronics. The technology itself is sound. It was developed by a team of physicists and is protected by a portfolio of patents. They went public via a SPAC, which in hindsight was the peak of the market's enthusiasm for this kind of pre-revenue technology story. The company raised a chunk of capital, but the SPAC structure also created a complex share and warrant structure that has likely contributed to the persistent selling pressure as those instruments became unlocked. This brings us to the future outlook, and the tension between expectation and reality is now a breaking point. The expectation, the bull case, is